Hey everyone, happy Wednesday afternoon. Hope you're doing well. Hey Dave.
Hello, Nathan.
How is everyone doing? Kind of a wild day in the market. Hi Shaheen, Sheepdog, Maggie, hello. Hey Des, hope everyone is doing well. All right, we are going to get kicked off here. Got an agenda, a couple things that I want to walk through. I mean, the first thing I can't help but talk about is what an unbelievable win on overnight options. The SPY was down almost 1%, and we just pulled out a W on a trade on overnight options, which keeps our massive hot streak rolling. I think 23 for 25 on overnight options. I got some emails from people saying, Nate, this was an hour and a half ago. Nate, I can't, overnight options lost. I'm so upset, that kind of thing. Fast forward 90 minutes later, we hit the profit target. So pretty thrilled with that. And guys, this goes back to that lesson that I tell people, that people have a really, really hard time with this lesson. The default management is to risk the entire trade and give it the max amount of time to hit the target. It's probably the thing with overnight options that people struggle with the most. I have many email exchanges. Nate, we're down 80%. Should we exit? My very boring answer is, well, no, the default is we hold on to the trade. We give it the max amount of time. Yes, the likelihood if you're down 80% is we're going to lose. But the risk to reward of going from negative 80 to positive 20 is so significant that, it makes more sense to keep the trade open. I have a whole lesson on that. If you guys want to go back, I'm sure I can find that. So that's why we don't close early. We keep the trade open. Yes, that means we're risking 100%. And we just follow the guidelines every day, even when it looks ugly. I think my trade was down 93% maybe at the peak today, and turned out to hit the profit target. So that's the first thing. Just a reminder there of using time to our advantage. When I use that phrase, I don't use it lightly. I mean, it is fundamental to the way that most of mine trade. So let's go ahead and jump in. Yes, I can find the lesson. It's an important one. I mentioned in Telegram. Everyone's in my Telegram, right? You guys see everything that I post in Telegram. Hopefully you do. Yes, we're just waiting for this little volatility shake. We will get the next overnight option will be coming out here just a minute. I just wanted, because we got a huge rip in both directions, just giving it a minute to settle down. I mentioned in Telegram that I got one of the wackiest fills that I've ever seen. Just pretty crazy. So let me show. You're not going to be able to see it really great because I tried to take a screenshot as best I could in real time. So you're not going to be able to see it perfectly, but I will walk you through it. So this is it. And what hopefully you can see is I took this trade. So what happened is, as you guys know, the Qs dropped pretty hard. And then about 9:56 a.m., that's what this time slot is here, you can see I took 10 contracts of QQQ, trading them to the upside with a debit spread. So the trade that I took here was a 563, 566 bullish call. Now, the reason I did that is because if you guys remember yesterday, I said when the market breaks way out of a tight restrictive range, usually it will have a snapback, right? So I played for that snapback after this consecutive move down, and I bought 10 contracts here. Now, what was really wild, and I don't think I've ever seen this before, is I got filled for 93 cents. Dave, is that clear enough that anyone's going to actually see the digits on the screen over here?
Honestly, I think the computers will and the phones probably can't.
Okay.
To be honest, it's kind of right above the line.
Okay, so So on these contracts, you can see they kind of filled. Sometimes, you don't get filled all at once. You get filled every couple seconds. That's what happened here. I got filled at 93 cents. So my potential ROI here on the full $3 spread was like, 350% or whatever. But I immediately put a target because I didn't actually want to wait and hold to the end of the day, although in hindsight, wish I did. But I didn't want to do that. I just wanted to get a target and get away with some money. So I put a target for $1.60, as you see. And in hindsight, listen, it would have got filled no matter what. But here's what's crazy. You guys should be able to see, hopefully you can see the price of QQQ right here. This is QQQ at the time of the entry. Now the price there, again, I'm not sure how well you can see it, is $5.60.
We're not seeing anything moving. Are you pointing at?
I'm just pointing to it with the cursor down here. I don't know if you can see my here. I can actually probably share in a way that you can see it. Let me share in a way that you can actually see it, because that'll make it a little more clear. I just want to show you how crazy this is, because I don't think I've ever gotten a fill quite like this on a high liquid asset. On something random that has no liquidity, sure, but on the Qs, which have massive liquidity, I don't think I've ever done that. So let me see if this makes it a little bit easier. So this is the Qs down here. All right. Now maybe you guys can see that a little bit better. And the price of the QQQ was $564.12 while this trade got filled. Now, the reason I'm making such a big deal out of this is because I took the 563. Wow, my writing is really good. 563, 566 call spread. Max value here is $3. Usually, you're not going to get $1.60 actual fill until this thing is like 565 plus. Because think about it. Actually, I'll ask you guys in the chat if anyone happens to know. For the market to fill me at 160, does anyone know what percentage chance they're implying that the Qs finish above 566? I'll give you a second if anyone happens to know while I am continuing to explain this. So I bought the 563, sold the 566. The full potential value was $3. At 12:20 p.m., that's when the sell limit actually filled. I got filled at 160, which even if you just took the intrinsic value, you would take 563 and add $1.60 to it. So you would basically take it up to 564.60. And that would just be to get like the intrinsic value, not including the spread, not including the implied move, nothing else in there. And yet this filled at 564.12, which is just wild, because when you're talking about spreads like that, that's a dramatic difference. I mean, 50 cents on a spread that you're only trying to get $1.60 to begin with is a massive, massive difference. And so for me, that was pretty wild. Yeah, some of you got it right. It is implying like a 60% chance that the Qs are going to finish above 566. Meanwhile, they're 564, almost 0.5% below that line in the sand. So I just want to show it to you. This is one of the reasons that I like having a target on, guys. If you have a target on, you let the market make it easier for you to make some money. Doesn't mean it's always going to hit, obviously, but you just make it a little bit easier for the market. Now the Qs are actually above 566, so we actually are getting that. It might even finish above 566, but of course at 12:20 we were almost down a full percent still. Had a very low likelihood that it was going to finish above 566 at that point, and yet I still got it. So how much did I make on that? Well, let's do the quick math here. You guys can see right over here, I got filled at 93. So I took the 563 and the, hitting buttons, sorry. 563 and 566. I did a 0.93 entry. I did 10 contracts, and then I got filled at 160. So you can see right there, I, for some reason, filled. There we go. I got filled there. I had a potential of 222%. My custom target is not right because I was typing it as a percentage. I had the potential of 222%, but instead I got out at right around this number at about 75% ROI, even though the QQQ really never even came close at that time to that framework. So again, that's where that target I really like having just sitting out in the market there. No, the entry was 93 debit, Bob. So you see my fill here, 93. That was my fill, and then my exit here was $1.60. So these contracts filled, sometimes you don't get filled all at once. It filled over a couple seconds until I got all 10 filled. That was at 9:56 a.m. At 12:20 p.m., I got filled for $1.60. Hey, Silas, I was just showing them. I had the craziest fill of my life today where I put on this bullish QQQ debit spread where the market was, kind of at the peak. I think it was down like 1.2% when I put it on. And I was just looking for a little bit of a snapback during the day. And it filled me at my $1.60 target when the Qs were still at 564.12. So it implied this way higher value on that $3 spread. And I was just showing, like, I almost always use a target. And this is kind of one of the reasons I like a target. Normally, you don't cheat the system and get a way better fill than you deserve. But it's just nice to have something out there and make it easy for the market to pay you. Have the target out there. If the, for whatever reason you get that mark up there and it fills, you'll take it. So that was probably one of the crazier fills I've had on a super liquid asset like QQQ. I mean, sure, if you're trading like a low liquid stock, you'll get some crazy fills. But that was pretty wild. Now, granted, in hindsight, I wish I just would have kept the thing open because now we are 566. But I thought that was pretty wild when it was still down almost a full percent that I got filled on that $1.60.
That's crazy. Don't go buy your stake yet. The exchange may reject the fill.
Okay, maybe I should hold in there. But like I said, now the Qs are all the way up there, 566. So maybe I should have held on to it. Anyway, we got another win on overnight options, guys, on a crazy back and forth day. Somehow I'm back to a positive P&L in my active trading account after I started out the day and pretty big in the red. So I'm counting it as a moral victory, even though the number's not very big. It's green, and I'm taking that as a moral victory on the day. Speaking of bouncing back, Silas is going to walk through potentially a little bit of a longer term opportunity to the downside, kind of in line with some of the seasonal stuff that he looked at earlier. And so because the market is actually bouncing back a little bit right now, I mean, the Q's bounced about 0.75%. The SPY bounced about 0.5%. Just from the day, it actually might give us a little better entry on the opportunity that Silas is going to talk about here. It's a little bit longer term trade, so you're not talking about massive differences, but a little bit of a better price to the downside. And then tomorrow, I'm going to take what Silas does today with that overall analysis, kind of looking at the path of least resistance on a couple of different assets. And I'm going to put a larger pair trade on between the large caps and the small caps. So I'm going to do that tomorrow. But today, Silas is going to walk you through specifically that path. We're going to do the S&P today, right, Silas, on the couple of paths? Okay. Yep. So he's going to give you the S&P one today. And then what I'm going to do is I'm going to take that and then pair it with a different trade on tomorrow's session. And then, by the way, one more thing, guys. At the end, we did that special this morning. I don't know if everyone was able to see that. Something I very, very rarely do, but we're going to do that. We're going to extend it. Well, I shouldn't say extend it. We never decided how long it was going to last in the first place. We're going to allow it to be open until tonight. So if for whatever reason, if you missed out on that, that's one that I highly recommend. I try not to go out of my way to shamelessly plug and say, hey, you got to have this right now. But this is one that I think does really fit the bill for where we're at in the market. And so if you stick around to the end, we have a very timely special we're going to do for that's going to expire tonight. So just keep an eye out for that as well. And with that, Silas, I will shut up now.
All good. All right. So I know you're pressed for time, and I'll quickly go through kind of my high-level analysis. Let me present. Put on present
You can
mode.
take your time, Silas. I'm going to be here. We'll keep it going as long as you have something to talk about, and then we'll switch over to what Nathan was talking about at the end. But
Okay. Cool.
Take your time.
Cool.
Yeah, if I disappear on you in the middle, don't mind me.
All right. Well, thanks for having me back on. Enjoyed spending time with everybody this morning. Just quickly, like Dave was saying, an incredible bounce back. I think what we're if we look at the S&P here with 15 minutes to go, still climbing higher, trying to probably come back to the open, what were 50, 60 some odd points off the low. So big range. That volatility is kind of kicking in that we talked about last week. Volatility expectations, starting to see maybe some larger expansions there as the market's starting to digest where we are. Knowing where we are seasonally, this is an overlay. I don't know who is with us this morning. Let me see if I can find the chat box here. But we talked a lot about the seasonal aspects. And so this really isn't a day trade. And I think Nathan already alluded to this. It's going to be kind of a longer term picture. But knowing the seasonal expectations of any market does allow us to kind of see that right-hand side of the chart. That's what I like to kind of reference. And this is a compare mode here inside of our software of the Russell versus SPY. So the SPY is in green. The Russell or small cap here, IWM, is in blue. And you can see the expectations here as far as the way the averages have worked together over the last 20 years or so. And when we talk about indices, or when I talk about the market, so to speak, I'm really generally speaking about the S&P 500. Most of the time you could take, any analysis or thoughts that we talk about and apply them in the Qs or the Russell or the Dow. But I'm primarily looking at S&P as kind of the starting point. And that is where I'm mostly going to put my trades in as well, either through S&P, SPX, SPY, could be do a lot of S&P futures options trading. So options on the E-mini S&P. And of course, you can now do that on MES or the micros as well, all very liquid. So it's a way to get your feet wet, your toes in the water. So if we look at the expectations here, somebody said I'm looking like I'm getting beamed up to the Enterprise. Sorry about that. We'll get it. We'll get a more professional cam going here. But so if we look at the S&P, we've got data going back to 1993. This is through the SPY. Actually, we do have data on the S&P futures itself. But this is, what I kind of keep going back to. Here's where we are, the 20th of August. It's not about, an exact date. Hey, the S&P or the market's going to do this on an exact date. Just gives us a general reference point. And so we are primed and pretty much positioned here to take a shot on a short trade in the S&P. I'm going to share with you a couple ideas here momentarily. And if we go back to, I don't have it pulled up right now, but if we go back, we looked at some of the CFTC, Commodity Futures Trading Commission, commitment of traders data showing heavy positions, new shorts being added from on a week-to-week basis by about 55,000 contracts last week. So I think that's something worth noting. And so here's what we're looking at. What I've done is I priced some options going, looking at the monthlies, the October monthlies. I think it's the October 17 expiration. Also looking, out through October 31st into months, but sticking really for most of you guys with those monthlies. That's where most of the liquidity, and with the S&P and SPY, SPX, you generally don't have to worry about liquidity. But what we're looking at here is putting on a bear call spread. Bear call spread, so selling one strike, buying one strike further out of the money for protection, collecting a premium, and really kind of sitting on that. And that allows us to start, puts us in this scenario right here. Let me see if the chart. Okay, yeah, you guys can see the chart. So what I've done is gone approximately 3.5% of the money, and 3.5% away higher from where we are, I should say. And pricing, 20, I start kind of looking at the 25-30 delta to give me a starting point. And, so that puts us in the SPY, puts us up here around 660 or so. If we look at SPX, that's not it. SPX cash index. Well, let's see if we can get it right here. SPX. Okay. I don't know. Doesn't like SPX for some reason. Maybe there's another asset chain I should be using. So anywhere, SPY. So looking to do a bear call spread up in this area. Again, I'll share with you those exact strikes and kind of the premium that I'm eyeing. But by selling, coming up here to selling premium, for those that do trade options or that are familiar, is we can get paid or we can be right if the market, we prefer for it to go down. We can go sideways and or we could even go a little bit higher, okay, and still get paid while we sit on that premium through time decay. And so that's kind of what the idea or thought process is. If we come over to the S&P, I'm really looking for a retest back into the 64 double nickel, 64.60, 64.70 range to put a trade on. And again, I'm going to talk about S&P, SPY, SPX. And if you guys want to do something similar in Qs or the Russell, I think Nathan's going to talk about that maybe tomorrow in his opening playbook session. But this is the general thought. Here in the SPX, I'm looking to go up to about 66 quarters. So selling 66 quarter by 66.30s for, let's just go ahead and get right to the deck here. And nothing fancy, okay? It's nothing fancy. So this is idea number one. We're looking to sell the October 17, which are the monthly expirations, selling 66 quarters, buying 66.30s for around $1.50. That's when I priced them probably about 30 minutes ago or so. I guess we can take a look. I keep thinking the market's closed for some reason. If we come over here, I don't know if I'm getting data right now. 66 quarters, 66.30s, $1.20 or so. But when I priced these, we're going for about $1.50. So that's generally kind of what I'm looking for. If we move to the SPY, this is idea number two, SPY, looking at same expiration, selling 66. No, I'm sorry. Let me see. That is not correct. Okay, I'm sorry. So the SPY, let me see if I can get my drawing tool out here. SPY. Sorry, guys. I will be a little bit better. So on the SPY, what we're looking at here is a 660, 665 call at $1.25. Okay, one quarter. So it's $125 per contract. And the risk management on this, so that's selling the 660, buying 665. So there you go. Selling 660, buying 665 call for $1.25. Risk management here is fairly simple. Just generally using a two-time premium. So if we double up here, we go from 1/4 to 2.5, 250. We'll look to exit. We'll also be looking at price action as well. For those that want to risk more and perhaps even risk it up to short strike, you can do that. Generally not recommended. Generally a good idea just to sell that thing, sell it, and when we get to two to three times premium received, that's when we kind of cut that. All right. So here is the last one. This could be done through ES or MES net credit. So this is a bear call, Rob. So we're selling in the ES or MES, we're selling a 66.75, buying a 67.75. That's going to bring in 40 points. Okay, that's 40 points. And so 40 points, each point in the S&P is $50. So that's going to bring in approximately $2,000 per contract. If you want to do a micro MES, options on MES, it's 1/10 of the size. Okay, so you just divide that by 10. You're going to bring in $200 per contract. Okay, and you're going to first thing you're going to see, man, it's 100 points. Wow. Keep in mind that options are treated a little bit differently in the futures options market. So there's going to be something called span margin. I don't have that just at my fingertips. You can plug that into, Toss or Tasty Trade or whoever you might use. They'll generally give you the margin on that. It's not going to be something outrageous there. Same thing here, same scenario. Really, what we're doing is we're selling the call. This is just kind of a more. It is a max protection. It is max protection, but it's more so just to reduce our margin. You can manipulate those strikes, up or down, depending on if you if you want to decrease the margin there. Same thing on this one. We're not looking to risk it up to short strike. We're looking to make that double premium. We'll be watching price action very closely as well. So on that ES. We said 66.75. Again, it's going to be, way up here, and we're not looking, to risk, willing to risk price all the way up here. If the premiums start to double and or things start to get more constructively bullish, then we would look to peel out of that position. Now, this is what Nathan, I think, is going to talk a little bit more tomorrow about doing kind of a pair situation. Is if we're looking to sell, maybe short the S&P through a bear call spread, credit spread, we're bringing a premium. Remember, you can kind of flip this around and say, hey, if I don't trade credit spreads, or I don't like credit spreads, or my account doesn't allow it, whatever the case may be, you can buy a bull put. You can buy an outright put. You've got to be more right and more correct directionally. You're going to need some movement to start getting paid. Otherwise, you're going to be losing out on that premium. But the pair trade would be against, I think Nathan's going to talk about IWM. He may look at Qs or possibly the diamond. But looking at the Russell here.
Yeah, he was talking about IWM, the Russell versus the SPY.
Yeah. Okay. That's what I thought. So with the Russell, I don't really have anything too clear right now. We knew that we know that we've got some, a little bit of kind of headwinds that we need to get through up here. So what I'm looking at on the Russell is I would like to see maybe, we're expecting the S&P to maybe retrace to the downside. Russell, if we pull back into some of these deeper pockets, we get maybe a 50% retracement from, say, swing high to swing low, a little bit deeper down in this area, then I would consider possibly putting on a bull call debit spread, or a bull put credit spread. I don't think you need to do both. You could do both. You could sell a bull put to maybe finance some of the bull call, but keep in mind it's going to be a double-edged sword for you. So if we retrace a little bit deeper, then look to leg into a bullish IWM trade. Alternatively, if, let's say, the market decides that we want to go higher and we start making new highs, then that could be a trade to put on as a hedge, so to speak, on the S&P trade. So that's kind of the thinking there. And keep in mind where we are in terms of time or the calendar year. So in a perfect world scenario, we get this retracement heading in through September, October. We've got OC 17 expirations on, and we'd be looking to, assuming that this playbook came out or followed our expectations. It sometimes does, sometimes it doesn't. If we do come down, this is a place where we'd start to be looking to exit the trade. So this is not, trying to get greedy here and hold off for every last penny or nickel. So we talked about the risk. Target wise, I like, close, depending on, if you're trading multiple lots, scaling out, things like that. Generally, a rule of thumb for me, buying, putting in a limited order, buying back 75, 80% of premium received. Okay, not getting greedy. Trust me, I've tried to hold off for that last nickel or that last dime because I didn't want to pay it back or pay commissions, whatever. And you probably know the rest of the story. Sometimes they'll come back and bite you. So what I'd like to see is put on the bear call here. And then if we play out as expected, we get into that October timeframe, then we would, of course, see the Russell and these other markets pull down as well. What we want to see is all that aligning right around. Let's see if we can find a little tool here that does a vertical line right around here to say October, right around here in October. This would be kind of the crossroads or inflection point there, where we then look to maybe put on a bull call, bull put, whether it's Russell, whether it's S&P, NASDAQ, or whatever. A lot of different options there for you. So I think that's really all I have. It's kind of short, sweet, and simple. And
yeah, perfect. I really appreciate you coming on again today, going through all of that. What Nathan is going to be talking about is with his strategy that he uses specifically about this is what he calls profit pairs, where he takes something like SPY, IWM, that kind of thing, that are correlated normally together in the long run, but that in the short term look like they might not go in the same direction. And then he'll go long on one and short on the other and build kind of a custom spread that way. And, either way it goes, we kind of covered in one direction or the other, if they are in fact, correlated to move in opposite directions in the near term. All right, so we are going to move into that presentation from Nathan that he talked about earlier. We are going to see a replay of that. If you were here this morning and went through it and already got into his profit pairs program, then you already have this. You're welcome to watch it again. If you didn't, let me tell you, there's an opportunity to get a lifetime membership today into his profit pairs for an extremely steep discount that is going to expire today at midnight tonight. So I strongly recommend, if you're interested in this profit pair strategy, that you stick around and watch this. Silas, thanks again for coming on. Appreciate you. We'll talk to you soon.
All right. Thanks, David. Appreciate you guys. Have a good one.
I mentioned yesterday, obviously, if you guys were on Closing Playbook, that I am really expecting volatility to enter the market. And well, I was right so far because we're getting some volatility entering the market right now. And so what I want to do is try to prepare you for how we can approach that volatility as it's, entering the market. And I think what often happens is people have really good stretches when the market's moving up. They tend to cough up a lot of that during, shorter times when the market's not working out. So my goal is to give you some tools in the toolbox, and I'm going to do it in a pretty awesome way. I think today that if you want to take advantage of, just make sure you stick around. So while my bread and butter, as you guys probably know, are directional and defensive trades, things like the income machine, I absolutely love using pair trades when volatility picks up. In fact, if any of you guys are in the pair trade right now, you know exactly what I'm talking about because we're already up big on a pair trade that we just put out yesterday, thanks to this awesome volatility. Now, I'm going to talk about the pair trades that I do personally. You guys know the drill, I'm sure by now, but I'll just do it just to make sure we're all on the same page. I'm going all the way back through our back testing starting in 2022 through my current live trades over the last couple of years. Win rate on this thing is phenomenal, 78%. Average win, 36%. Average loss, 76%. Crazy. The average return, net return, winners and losers, over 10% a week, grinding out even in these slower market conditions. So this is a strategy that I absolutely love. Now, like I just said, the crazy thing about profit pairs is that it's actually been crushing even in the slower conditions that we've seen lately too. And I'll cover more on that in a moment. But where it really shines is in the more volatile markets. Now, if you're not familiar with pair trades, it's one of the most robust strategies for providing protection and upside at the same time, which when you look at, the Qs being down 2%, now 3.5% over the last 2 days, that becomes pretty important. Now, it's essentially adding or pairing a strategic short to every long position with the goal of making money on the difference between those two. But don't get fooled into thinking it's some complicated, straddle, strangle, iron condor, nothing like that. These are some of the most basic trades you can put on. You only need level 1 options to trade these, which